In this week's video, we'll ask and answer 6 key questions for stock market bulls. We'll be moving quickly, so feel free to use the pause button on your video player. We'll be looking at stock market breadth, inflation and recession odds, short and long-term trends, and we'll finish up with stock market leadership. Does weak stock market breadth mean a bear market is imminent? Well, there's no question that small caps are laggards. This is a weekly chart, IWM in the ETF world, divided by SPY. The ratio remains well below a downward sloping 200-week moving average in red, and is hovering right around a new 52-week low. Chart on your screen dated June 28th. However, if we look at small caps in isolation using the same weekly chart with the same weekly moving averages, 200-week moving average in red. This is an encouraging rather than concerning chart. This tight cluster of moving averages in here, price remains above the moving averages, blue the fastest moving average, the 30-week moving average is on top, and this consolidation that's been taking place for the most part during the entire calendar year in 2024 is occurring above this base here. So while small caps are laggards, they're not screaming imminent bear market or even imminent downtrend. And if a clear laggard still looks pretty good in isolation, what does that say about the leaders? They must look even better. Also noteworthy, similar to the moving average chart that we just covered, small cap anchored volume weighted average price chart. This looks like a constructive breakout, a discernible shift relative to what took place back here in 2023 and 2022, and healthy consolidation above these anchored volume weighted average price lines. As long as IWM stays above the anchored volume weighted average price line band here, the bias is to the upside. Look how long IWM has been above the anchored volume weighted average price line tied to this Q4 2021 high. This is a line during the bear market where IWM was rejected several times. Here, 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 and here. This looks discernibly different and discernibly more encouraging. Similar situation when we look at the equal weight S&P 500 RSP relative to SPY. You can see RSP relative to SPY is clearly in a downtrend. But once again, the equal weight S&P 500, much like IWM, in isolation still has a healthy looking weekly chart. Price well above an upward sloping 200-week moving average. Price made a stand at an upward sloping 200-week moving average in 2023. Has cleared this period here, this basing period of consolidation. And right now on the weekly chart, we have a full bore bullish look with blue, the fastest moving average on top, red, the slowest moving average on the bottom. The slopes of all the moving averages are up, and price is above all of the moving averages. That's significantly different relative to the look that we had in here in 2022 during the bear market. So while the mega caps continue to lead, the other sectors in the S&P 500, when we look at them on an equally weighted basis, they're not screaming we're on the ropes and we're about to shift into a downtrend. As always, the commentary is based on the chart in front of us. Right now, this chart leans encouraging rather than concerning. We also have a breakout above this high here from 2021, and this consolidation that's taking place here is occurring well above this base down here, and for now, above this breakout level from 2021. And once again, if the chart of a laggard looks pretty good, then the chart of the leader, the capitalization weighted S&P 500, by default has to look better. And very, very similar to the commentary that we tied to the anchored volume weighted average price chart for small caps, IWM. Yes, RSP is lagging SPY, but there's nothing particularly alarming on the anchored volume weighted average price chart. You can think of this line back here as the bear market demarcation line, and you can see price was rejected near that line several times. We made a stand in the general area here last October. We broke above it, and right now we look like we're in a holding pattern that's relatively healthy above this base down here, and again, above This high back here from late 2021, early 2022. Also noteworthy, the slopes of all of these anchored volume weighted average price lines, they lean upward, which means they're leaning bullish. If RSP dropped into this area here, we would learn something about increasing bearish probabilities. Stock market breadth speaks to participation. How are stocks outside of the S&P 500 performing? Relative to this low here in 2023, not all that poorly for laggard small caps. They're significantly higher than where they were in Q4 of last year. The same can be said for the equal weight S&P 500. It is significantly higher relative to where it was in October of last year. How about global stocks? Have they been participating in any way? Global stocks are also clear laggards. This is VT, the Vanguard Total World Stock ETF, relative to SPY. Full bore bearish look. Once again, we follow that up with a however. A clear laggard has a very attractive weekly chart in isolation. It's very, very difficult to say anything other than uptrend or bullish trend when you look at this chart. It has a full bore bullish look. It broke above the consolidation box down here when we were trying to reverse the downtrend from the bear market. It retested that breakout in October of last year, and that retest passed, and then eventually global stocks VT exceeded this high here from Q4 of 2021. What does it say about your leaders when the charts of your clear laggards look healthy? Thus, weak breadth is absolutely, positively relevant. But given what we know today, any pullback related to weak stock market breadth would most likely be just that, a pullback within the context of an existing uptrend, rather than a full-blown bear market as we saw in 2022. Question number 2, is inflation going to flip us back into bear market mode? Chart on your screen is dated May 14th. We covered this chart in a mid-May 2024 video. This is a basket of physical commodities, the CRB index relative to the S&P 500. Once again, it's a weekly chart. This is the COVID low here in 2020. And when the government started printing money hand over fist and handing out money hand over fist, the market became concerned about inflation. And hence commodities, physical commodities, started to outperform the stock market. So this is what the ratio looks like when the market is concerned about inflation, interest rates, and Fed policy, into this look here where it spiked higher very, very early in 2022, which would be very, very early in the bear market in 2022 when the stock market's going in this direction. So in mid-May, we said inflation doesn't appear to be a problem. How does the exact same chart look in June? The look of the chart on June 28th is telling us that market participants do not appear to be particularly concerned about inflation. This is where the concern started in 2020. This is where they really started to ramp up in 2021. And this is where they shot off like a rocket in early 2022. Contrast this, and this with this waning fear of inflation look here in 2023 and 2024, and the ratio is hovering right around a new 52-week low. And unlike the early portion of 2022 in here, where the 30, 40, and 50-week moving averages crossed above the 200-week moving average in red, we have the polar opposite in the present day. This is January of 2022. Just as the bear market is starting, the ratio slices right through the 200-week moving average in red. Contrast that with the look over here. In late 2023, we dropped below the 200-week moving average. We retested that in 2024 here, and it looks like a successful retest. The past 6 to 8 weeks, we've covered this ratio numerous times. This is XLE Energy, the S&P 500 energy sector, relative to the S&P 500 tech sector. This is what rising concerns about inflation look like. This is early 2022 again. Here's the stock market correction in 2023, increasing concerns about inflation. The stock market's going in the opposite direction. And at this point here, when you drop below this anchored volume weighted average price line tied to this low, the correction in the S&P 500 ended. And as we mentioned, this chart, the larger chart, is dated April 19th. And we said this move here looked more corrective in nature and looks similar to this move here in 2023 relative to this big spike in 2022. So how does the same chart look today? This is the point here where the correction ended. This is the S&P 500 down here in 2023. We dropped below the anchored volume weighted average price line tied to this low. As you can see, we're below all of these lines here, the blue, the orange, and the mustard line tied to the low here. So you can make an argument that this look in here is similar to this look in here after the correction in the S&P 500 was over. This chart, too, in its present form, does not look particularly concerned about inflation. How concerned are market participants about an economic recession? It's difficult to see. Upper left-hand corner of your screen, chart dated May 23rd, 2024. We covered it in the month of May in one of these weekly videos. This is defensive staples relative to the S&P 500. You can see here as economic fear was increasing in Q4 of 2007 into Q1 of 2008, the ratio took off like a rocket. If you know your stock market history, in 2008 and into March of 2009, that was a horrible time to be in the stock market. That's the financial crisis. You can see in May we had almost the polar opposite over here. We had the ratio below the moving average, which was turning down. Here we had the ratio on the left side of the screen above the moving average that was starting to turn up. So on May 23rd, this chart told us that the market wasn't particularly concerned about a recession, or the market wasn't particularly concerned about getting defensive. If we fast forward to June 28th, it's very, very difficult to make the argument that market participants, especially large money managers, institutional money managers, wanted to get defensive in June. XLP lagged SPY by 4.2%, and that's as of 11:32 a.m. There's nothing particularly fearful on this chart. If the chart changes, then we'll have to reassess the probabilities. The previous chart was a monthly chart. This is a weekly chart of the same ratio that we covered again in mid to late May. And at that time, we said this looked like a counter trend move in the ratio within the context of an existing downtrend. This chart dated May 23rd. This chart making a new 52-week low dated June 28th. And for now, this turned out to be a counter trend move within the context of an existing downtrend, and now we have exceeded this low here from April of this year as we head into the month of July. This defensive ratio is checking all of the bearish boxes, which is bullish for the stock market. A traditional bear market and a traditional economic recession, those tend to be deflationary events. And this is what a deflationary event looks like, or increasing fears about an economic contraction and or deflation. This is January of 2008 here. This is a weekly chart. This is the 200-week moving average. We're looking at the ratio of 7 to 10-year Treasury bonds relative to the S&P 500. Just think defensive bonds relative to more aggressive stocks. So if we go here into late 2008, we have a full-bore bullish look, or a max fear look, with blue the fastest moving average on top, red the slowest moving average on the bottom. And why does this happen when market participants are concerned about an economic recession? Well, number one, in a recession, earnings tend to take a hit, and thus that's not particularly good for stocks. And in a traditional recession, the Fed tends to lower interest rates, and that is good for bonds. And that's why this ratio looks like this in the financial crisis. IEF did quite well in the financial crisis. SPY did very, very poorly. So do we have a deflationary fear look on this chart today? Do we have an increasing economic fear look on this chart as we did in 2008 if we look at the same ratio On June 28th, 2024, we do not. We have, for the most part, the polar opposite. During the financial crisis, max fear, max economic fear, max deflationary fear, we have a full-bore bullish look. Today, full-bore bearish look. Blue, the fastest moving average on the bottom. The slopes of all the moving averages are down, and price is below all of the moving averages. It's hard to make the argument that some catastrophic economic event is right around the corner. If the market was starting to get concerned about all of these issues, we would expect this short-term chart of the NASDAQ Composite Index to look more like this over here. This is the early stages of the correction in Q4 of 2023. If we look at the same exact chart with the 8-day moving average all the way out to the 50-day moving average, during the trading session on June 28th, we don't have anything that looks like this down here. Obviously, that's subject to change, but it hasn't changed yet. And even on this very short-term time frame, we have a full-bore bullish look, with blue, the fastest moving average on top, gold, the slowest moving average on the bottom. The slopes of all the moving averages are up, and prices above all of the moving averages. Contrast that with the look down here in the middle of the correction in Q4 of 2023. This doesn't really look anything like this. Everything that we just said about the chart of the NASDAQ Composite applies to the chart of the S&P 500. This is intraday on Friday, June 28th. How does 2024 compare to the dot-com bust bear market? Said another way, do the long-term charts look similar to the year 2000? The S&P 500 peaked in March of 2000, and the bear market began in earnest in September of 2000. It's a long-term monthly chart of the S&P 500. This is the secular bull market from 1982 down here until March of 2000 up here, when the dot-com bust bear market kicked off. This is what the end of a bearish period looks like. This is a bullish turn here in 1984, a bullish turn here in 1988, a bullish turn here in 1991, and a bullish turn here in 1995, where price moves back above the moving average envelopes and the slopes of the envelope turn up. Contrast that with the early stages of a correction, where price drops below the moving average envelopes during the crash in 1987, and the slopes of the envelope roll over. Thus, if the answer to this question were yes in the present day, or is going to be yes in the coming days, weeks, or months, we would expect the present day chart to look more like this up here, the peaking process. And notice how price is running out of gas in here. It's stalled, and it's kissing the moving average envelope, waving yellow flags, telling you this trend right here is not nearly as strong as it was back here in 1995, where price is well above the moving average envelope. So we just covered numerous scenarios. The early stages of a correction, the end of a correction. We just showed you what a strong trend looks like, and we just showed you what a long-term weakening trend looks like. If we look at the same chart in 2023 and 2024, what can we learn? This is the chart that we covered in the September 22nd, 2023 video in the middle of a stock market correction. And the message was, this looks like a pullback within the context of a favorable setup. This right here looked more like this, this, and this relative to this, and this. If we take the same chart out to June 28th, 2024, we have price well above the moving average envelope. The slope of it has turned up in a constructive manner, and there's a lot of white space between the envelope and price. There's a lot of white space between the envelope and price. Dating all the way back to the bottom in October of last year, price has not touched the envelope once. Contrast that with this weakening trend look back here in the second half of 1999. We touch it 1, 2, 3, 4, 5 times before things really get ugly. Probably fair to say this looks like a strengthening trend relative to a weakening trend. Not a prediction in any shape, form, or fashion, but this is factual here. We can see it, measure it, and put it in a model. In this look here, relative to everything that we talked about on this chart here, the June 28, 2024 chart aligns with the bullish demographic thesis that we've been covering for years, and the concept of the millennials moving into their peak earning and spending years. Do we have any evidence in hand today that the long-term leadership trends in the market have shifted or are beginning to shift? This is the same weekly chart that we've used previously in this video. This is the 200-week moving average in red. This is the 30, 40, and 50-week moving averages over here in blue, green, and pink, respectively. The chart shows you IYW, the iShares Technology ETF, relative to the S&P 500. This is the period in here in 2021 where the market starts to get concerned about inflation. This is the bear market in 2022 when tech underperforms SPY. And this is the look on June 28th, where we have a full-bore bullish look in favor of tech, and we're hovering right around a new 52-week high. Similar situation if we look at XLK, the S&P 500 tech sector ETF, relative to the equal weight S&P 500 ETF. So the tech sector relative to all the sectors in the S&P 500. Once again, the chart is dated June 28th. The ratio is hovering right around a new 52-week high and has a full-bore bullish look, with blue the fastest moving average on top, red the slowest moving average on the bottom. Price above all the moving averages, and the slopes of the moving averages are all up. In the red box, the market is very concerned about inflation, and it's not unusual for markets to overshoot, and you can see the ratio overshot the long-term trend here by dropping below the upward sloping 200-week moving average. And we know that secular bull markets tend to make a stand at or near an upward sloping 200-week moving average, and that's exactly what happened with this ratio. We overshot late in 2022, and now we've recaptured that bullish trend look with price above that all-important upward sloping 200-week moving average in red. Very, very similar situation with growth stocks relative to value stocks. When the market is concerned about inflation in this window here, value stocks significantly outperformed growth. That's not what we have in the present day. On Friday, June 28th, around lunchtime, growth was outperforming value by 1.57%. We have a full-bore bullish look favoring growth over value. And we also have a bullish breakout above this peak here in 2021 and this peak here in the year 2020. If we go back to the original question, is the market rotating away from tech? The answer would be no, looking at this chart here, XLK relative to RSP. And if we looked at quarterly returns, the answer has to be no. SMH, the semiconductor ETF, intraday on Friday, a full Q2 return over 16%, SCHG growth approximately 9.5%, XLK Tech over the last 90 calendar days, 9.5% approximately, VU, the S&P 500, a very respectable 4.9%. We know it's extremely important to keep realistic expectations about how markets operate in the real world. With a number like that, a number like that, and a number like that, an outperformance relative to VU here, it wouldn't be surprising if tech took a little bit of a breather over the next 90 days. And that may be true for the market in general. But based on everything that we've covered, if the market pulls back, corrects, or goes sideways, the data that we have in hand says the odds are that that will be followed by a higher high and higher profits and higher account balances. Still making good progress on the research relative to the secular volatility model. and still on track relative to these bullet points on the upper portion of your screen. It's also noteworthy, Wall Street Journal headline dated June 16th, investors fear long stretch of calm in markets can't last. That's not the type of headline that should make us concerned. The type of headline that should make us concerned is investors feel the S&P 500 will never ever fall again and stocks can do nothing but go up. That would be concerning. After an excellent quarter, this study from Sentiment Trader tells us to keep an open mind about more muted performance in the coming months. Sentiment Trader Twitter handle down here. The average S&P 500 stock is faring much better than a NASDAQ stock. How concerning is that? Well, given that the average return after similar signals looking out 12 months was 16% in the NASDAQ, not particularly concerning. The median return looking out 12 months, 18.4%. 88% of the cases, the stock market was higher. However, from a shorter-term perspective, nothing to get too excited about. Looking out 1 week, 2 weeks, 1 month, 2 months, and 3 months, especially 2 months out. The average return in the NASDAQ, less than 1%. The median return, 2.3%. Looking out 3 months, only 62% of the cases, the NASDAQ was higher. Thus, it wouldn't be shocking if things calm down looking out 1 week to 3 months. But this too tells us that most likely any weakness in the orange window here would be followed by higher highs eventually, and that speaks to probabilities. Also noteworthy, all of these signals tied to this study here occurred within the context of long-term uptrends for the most part. This is the late 1970s here. This is the S&P 500, and this goes into, let's say, 1999. And notice, none of these signals occurred within the period of secular stagnation in the red box, and then they started to occur again when we entered a new secular trend in recent years. These are the numbers for the NASDAQ Composite. Similar, have realistic expectations about how markets operate in the real world results. Here, market didn't do anything particularly impressive looking out 1 week to 3 months. However, 6 months later, the average gain was 5.5%. The median gain was 6.2%. 12 months later, average gain roughly 12%. The median gain roughly 12%. 88% of the cases, the stock market was higher 12 months later. And once again, all of the signals occurred within the context of favorable periods for the most part and did not occur within the context of the dot-com bust bear market nor the financial crisis. So everything that we just covered tells us we want to make sure that fear relative to normal pullbacks, normal corrections, and normal periods of consolidation don't get in the way of our primary objective, which is staying with the secular trend as long as the data allows. And we all know the only way that we can do that effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.